Hello everyone, I'm Fiona Solomon and I'm the CEO here at ASI, and welcome to this month's 45 Minutes on webinar session. We're going to talk about the emerging ESG paradigm shifts that are happening across industries generally. And for that, it's a really great pleasure to welcome Raj Aseervatham. He has 30 years of experience across operational, executive consulting and assurance roles globally. He's currently a non-executive director and a board advisory professional. Last year, he authored an MBA textbook called Leading Tomorrow. Just next slide for some housekeeping. Thanks, Thad. So before I hand over to Raj, a quick reminder that we do want this to be an interactive session. So please share your questions in the Q&A box as we go along. You don't have to wait till the end. We'll aim to get through as many of your questions as we can in the time that we've got together. And the session is being recorded for those who are unable to make it live. So over to you, Raj. Thank you.
Thank you, Fiona, and thank you everyone for joining. I might start with just a recap on the last couple of years. And my personal reflection has been that the COVID pandemic, while it has slowed down most sides of life, from my professional perspective, it has speeded up ESG momentum. Not because of COVID-19, but just that intervening period. And I'll go through, on the slide there, you'll see a couple of aspects that I'll just go through to put some context around that. What I'm seeing as an example is that the use of risk-weighted capital in industry is starting to show as a material input to financial decisions. So previously, access to capital was potentially easier than it feels today. ESG aspects have started to impinge on the flows of capital, and if your ESG performance, particularly in areas of considerable risk for the organization, is poor, then the access to capital is harder, and the percentage, the risk weighting on capital is higher. In accordance with that, and I guess in parallel, we've seen institutional investors' fear of climate change increase, and that's been for a number of reasons. Potentially for me, because from what I've seen, is that the narrative around institutional investors and climate change has escalated, certainly since about 2015-16. And since the TCFD, the Task Force for Climate-Related Financial Disclosures, came into force or into effect, that narrative has grown larger and I guess more intense around what climate change means to the stability of capital markets. We've seen in the last couple of years, if you remember AMP Capital, and if you remember the Jukan Gorge, we've seen some ESG embarrassments that have occurred during this last couple of years that have heightened the conversation and the board level debate associated with that. How do we control ESG? What is ESG? ESG is a very wide range of parameters. So that debate has escalated. And again, from my perspective, in the last couple of years, that has become more of an everyday occurrence than in the past. If any of you read the Australian newspaper, and there might be some of you from Australia, the Australian Financial Review, just 3 years ago, it would be very hard to find mention of ESG in that paper. And now I can rely on seeing ESG articles in context, so relating to an issue that a company is facing, appear in that newspaper 3 or 4 times a week, and that seems to be quite normal now. The G in ESG has been equated with leadership. Previously the P&L focus and the focus on securing your supply chain issues, for example, were top of the pile. The G in leadership has escalated. The G in ESG around leadership has escalated, and I hear a lot more about governance as a leadership hallmark. So not just leadership for leadership's sake, but governance in the sense that how do we manage a company with a variety of risks, many of them ESG related. What does governance look like? What does good governance look like, and how does leadership and the board affect that governance? So they're just a few, and I've put down a couple more there. Supply chain brittleness, certainly COVID-19, and then the Ukraine war has focused us on the brittleness of our supply chain. And what that's done from an ESG context is it's allowed the focus on supply chain ESG to actually find a seat at the table as well. Next slide, please. So if I can just maybe start with institutional investors, because my experience has been that that's where the more forceful debate began. And in my executive career, I went from never hearing an institutional investor speak about sustainability or ESG to something that's very much programmed for in the investor roadshows in the last few years, certainly since about 2019. So if I look back 10 years, typically what would happen would be in an investor roadshow, we'd talk for 10 minutes about safety, maybe another hour and a bit around finance and sustainability. In my role, I would ring that in often, or investor relations would be able to talk about it at a roadshow, or sometimes someone from corporate affairs might do it. So it was kind of light touch only 10 years ago, and that's not a very long time. Nowadays, I can pretty much rely on the order to be swapped, not all the time, but often. 10 minutes on safety still seems to be a hallmark for those conversations. 45 minutes on ESG, typically on the top 3 risks. That would be fairly standard for an investor roadshow. And then we spend the time on finance. And I think part of the reason is that finance can be captured in black and white documents much more easily than ESG can. ESG tends to be a new aspect of the conversation. It isn't as codified as finance. And so the conversations tend to be wider and more diverse and more exploratory, shall I say, in that space. So I've seen that change in the last 10 years and more rapidly that change has occurred over the last couple of years. If I look back to the sustainability reports that used to talk about climate for perhaps 5 pages or 10 pages, now we've moved to the TCFD that I mentioned before, so a standalone report on climate risk, and that is much more codified around risk and really does look to materiality within climate risks for an organization. On the heels of that, we're seeing the TNFD, the Task Force for Nature related financial disclosures, and that's a new but emerging aspect. It's certainly significant, and if you look at the pattern, TCFD just a few years ago, TNFD now, that is quite a rapid escalation of codified discussions around sustainability issues over and above the sustainability issues. We've got water focus reports, and they've been part of the mainstream, I guess, now, particularly with the larger companies for perhaps 5 years, 6 years now. But they're becoming more and more relevant, particularly as they relate to climate. And again, that's another signal that the conversation topics around ESG are clustering into the investor arena. We're moving from the old global reporting initiative that's still around, of course, still very relevant, to a more distilled or focused SASB, or the sustainability standards for accounting, and that's being used more and more and being applied more in earnest by the stock exchanges. The New York Stock Exchange, the Australian Stock Exchange, are both seeing that as a valid shorter list, if you like, of the relevant ESG aspects. So really, we've moved, I think, from investor interest that was, politely asking about sustainability to more issue-based exploration of sustainability and ESG risks. Next slide, please. So the narrative too is changing, and I guess over the last few years you would have seen a lot about greenwashing, and greenwashing is sort of the new the new paint of shame in our narratives around ESG. But there are a couple of changes. These days, I'm finding that stakeholders and institutional investors in particular, they're interested in yesterday's story, certainly to see how you're tracking, but they're more interested in tomorrow's outlook. How are you shaping up for these risks? And when they say these risks, often it is about climate change, but it is also about supply chain risk. It is also about human rights, child labor, forced labor issues in your supply chain. What does that look like to your reputational capital? How does that look like to your market? Will your market accept you more readily if you're not looking after those risks? So there's a lot of forward conversations that I'm seeing compared to just a few years ago. Certainly, we've gone from glossy celebration, the beautiful looking sustainability report, to investors really poking through and saying, well, what's a realistic prognosis? What does that trend mean for the future? How should I look at that risk aspect in the light of investments that I might make in your organization for the next 5, 10 years or thereabouts? It's gone from the sustainability reporting. Our narratives have changed from telling our story, and we'll still hear a lot of that. I still hear in boardrooms, let's tell our story better, and that's still a valid aspect. We do need to tell our story better, but they need to be linked to the facts that stakeholders need to hear. Stakeholders are asking for the stories about certain ESG aspects, and so our narration is being shaped more and more by what stakeholders are expecting to and needing to hear to make their decisions. We've moved from an era of disclosures that we could take a little bit of creativity in the way we talked about sustainability to now a harsher look at what we were saying, what we were intending to saying, and how that might have impacted on particularly investors' decisions about the long-term viability or long-term profitability, long-term prognosis of the company. So we've gone from that no harm, no foul to I'm trying to think of the companies that have fallen afoul of this recently, but ExxonMobil is one, Peabody Mining is another, and I think H&M are going through a similar issue with greenwashing. And it's not just a hall of shame issue. There are then legal proceedings that follow on from that. There are more determined steps that other stakeholders are taking. Next, please. I guess all of those conversations, of the many ESG factors, and depending on your vantage point, there may be 30 or 40 ESG factors that might be in scope for what you're managing in your organization. But really, the focus is increasingly around risks. And so, what are the ESG risks that your company is facing, either directly, and that might be through your own market access, or through decarbonization, or through environmental management, or indirectly, in the sense that stakeholders lose their trust or their willingness to engage with you, whether as an investor or whether as a customer, or whether even as an employee. So what we're finding is that the risk related to ESG has taken on I guess a more nuanced meaning. We're seeing a lot of that now, I think, with the skill shortage, the difficulty that many companies right across, certainly in Australia, are finding in securing skilled, semi-skilled and unskilled labor for longer periods of time. We're finding that people are making different decisions about how and why they would work for a company. And not all of that is ESG related, of course, but who do I want to work for has many ESG factors. How do they treat me? How do they treat the workforce? Would I be proud to be working for them? So those risks are starting to emerge. Many of you will be aware of this report, but the global risk report that comes out every year, I would recommend having a look at. The pictures you see in front of you are just the chapter headings that give you a bit of a flavor of what it talks about. But very interestingly, if you look at chapter 1 for 2021, for 2022, if you look at chapter 1, what you'll see is a bit of a trend of the top risks by impact and by likelihood that have manifested in this report over the last 10 or 12 years. And you'll see a drift. You'll see that more and more ESG risks are congregating to the top around both impact and likelihood. So if you're imagining a risk matrix, they're congregating around the top right-hand corner, and they have been for a couple of years now. Since about 2018, 2019, climate change has been fairly prevalent in the top right-hand side there. Water stress has been in the top quadrant, and so we're seeing these risks emerge and stay there. So they're not a fad, certainly. In investor meetings and summits, often the risk outlook is considered in the earlier sessions of summits, and it's interesting that the debate around these risks that are, to all intents and purposes, ESG risks, form a very large part of the conversation initially. Certainly this year, we're still talking about things like supply chain risk, but the issues around supply chain related to, for example, the movement of supplies across borders related to wars is part of the conversation. That conversation moves into the human rights issues related to supply chains in areas of conflict. So many of those geopolitical risks are playing out in ESG factors within the World Risk Report. Next, please. So while those changes are taking place, and just looking back on my career, which has been around 30 odd or 30 something years, I feel that there's been a lot of go slow for the first 25, 26 years of it, and then hurry up and go fast in the last sort of 3 or 4 years of my career. And so the conversation has really escalated. There's a sense of urgency, if you like. There's a sense of needing to catch up around the ESG agenda. So on this slide, I'd like to talk about the before and after, perhaps, of what companies are trying to do to close some of that gap, to build capacity. On the left-hand side is a typical governance structure. You've got the CEO in the middle, the board at the top, your executive leadership team below that, and many of you would be you would recall or recognize the structure in the bottom there, where ESG reports into a corporate affairs or a strategy function within the executive leadership team. The risks related to both financial and non-financial risks are typically fielded by the ARC, or the Audit and Risk Committee. So some of you might call it the Risk Committee or the Risk and Audit Committee. So that's typically been how governance looks like around ESG. It sort of filters through the CEO, goes to the ARC. If it gets there at all, it does depend on the strength of the risk register or the risk process. What I'm seeing now is something more like the right-hand side in green. And so more and more, and I think in Australia, we're still only around 5 or 6% of companies have this. There's a sustainability committee. The sustainability committee often looks after safety and sustainability. It sits alongside the Audit and Risk Committee. And increasingly, and I think it's very early days yet, the seat at the table around ESG is being focused on roles such as the Chief Sustainability Officer. So effectively, the ESG agenda is finding more and more time at the head of the table, and that is sometimes manifesting in new roles in the executive leadership team. So similar to the Chief Information Officer that became more prevalent a few years ago. The CSO role, or the CSO activity, is finding more and more time at that table. I think recently there was a report by Korn Ferry, I believe, that tracked the increase of CSO roles around the world, and certainly that momentum was noticeably fast in the last few years. So governance is starting to pin capacity both in the board structure and executive leadership structure, and that's a very important paradigm, because I think it bodes for a different future of ESG governance in organizations going forward. As I said, it's still early days yet, but it is a noticeable trend. Next, please. We're getting more and more stakeholder-centric in our thinking, in our conversations about ESG. Certainly, there's a lot of science, both social science and environmental science, in there. That there's a lot of governance control within our organization that's very internally focused. But increasingly, we're understanding that a stakeholder-centric model gives us a better view of the expectations around ESG and how those things might change in the world outside. I think there's a very popular saying that laws or legal instruments are often a lag indicator of societal needs. And if you listen to stakeholders, you often get a view of what those laws might be in the future. So the stakeholder-centric model gives us a bit of a heads up on some of these emerging ESG needs of stakeholders that might result in policies or legal requirements in the future. So they're listed there, but just to maybe hit on a couple of them. I've talked a fair bit about institutional investors. Customers in markets are particularly around the future metals, are starting to look down the supply chain a little bit more intently. How do I know that this future metal, particularly say for the EV sector, the electric vehicle sector, the technology sector, how do I know that my metals have a responsible supply chain? What instruments do I need to use to interrogate that particular question? Retail investors as opposed to institutional investors. So institutional investors are the large BlackRocks and the Vanguards of this world. Retail investors are the mum and dad investors who collectively make up the input into institutional investment in no small part. Retail investors, more millennials entering the market, more women entering the market, which is the investment market, which is actually changing the ask, if you like, of where the investment dollar is going, what it's being invested in, what's the return as well as what's the good. So that the question is broadening from the retail investor spectrum. We have supply chain actors. So at the moment, if you're in the middle of a supply chain, if you're a miner or a smelter in a supply chain, your supply chain actors up the chain towards your final product are asking more intensive questions. You as a metals actor are also dependent on your supply chain to make sure that the chain of custody of your materials meets the downstream supply chain actors' needs. So those connections are starting to get forged more and more intensively, and that energy is coming from stakeholders. Next, please. And finally, I just wanted to touch on the time frame that we're talking about, and for those of you who know a little bit about project management, you'll recognize this curve. It's called the S curve. It's a typical view of what effort looks like over time. So you start off your effort. So that's a red line. You start to grow in intensity and effort as you get into the task at hand, and as you complete the task or as you near effective completion, you start to flatten off and tail off your effort on that particular task. And the bars show you, what that incremental effort looks like year by year. If you think of those bars as sort of 5-year increments, I think in the space of ESG, we're somewhere around bar 3 or bar 4. If you think of the middle of that the bar chart with the highest peak there as being 2050, when we're collectively hoping to achieve a carbon neutral future in most countries of the world, those 5-year blocks sort of make sense. So just in context, even though these paradigm shifts are happening now, I believe that we're really at the start of a process, at the start of a chain of momentum. We're not seeing the greatest effort yet. We're seeing the start of that effort. We're seeing a need to change the way we think about leadership in ESG, change the way we think about governance, so that it's a lot more linked to how we do business every day. It's a lot more linked to strategy. It's a lot more linked to stakeholder expectations. So many of those paradigms are changing within an organization. So the takeaway I'd have for you there is, and again, my experience has been a little bit happened every year since I began in this field. And then over the last 3 or 4 years, a lot has happened. And I expect that to continue for hopefully a good couple of decades yet. The more effectively we can do that, the faster we can climb up that curve, of course. Next slide, please. And thank you very much.
Great. I turned my video on and then I thought there was another one, but that was excellent, Raj. Thank you very much. We've got a question in the Q&A and a reminder to share your questions as well, but this one's from Mohammed. How do you measure, or what's your sense of how this increase in end customers' requests for ESG information of the product? How have you seen that start to evolve?
It's a good question, and it's a bit of a paradox, because as soon as you start listening to what end customers are asking for, and it's not just the end customers, it is many other stakeholders, but as soon as you start listening, you hear more. You hear more about what constitutes an edge for your customers. So price is always an issue, but if price was equal, then there are other factors. So the measurement is I'm not sure that I've actually gone through the process of measuring, but it's substantial. So if we were to sit down with an Apple or a Volvo, the list of expectations is reasonably long, but the top 3 or the top 5 are the ones to focus on. There's no demand to fill the whole list, but there is a list. So what I'm seeing is that, particularly in retail customer-facing segments, so where the end customer is a person, and the person might be, of the 20 to 40 sort of age group, that the end customer's requests are typically higher in expectation and longer in length around ESG information.
That's great. It was really interesting when you touched on the corporate governance sort of transitions in terms of the board and the senior management team structure. And boards, traditionally have focused on that legal and financial expertise, but not necessarily having that ESG expertise at that level. How are you seeing that expertise start to be strengthened on boards?
Yeah, it's a bit of a conundrum, because as you know, most boards are sort of 7 to 11 people, let's say, on a board. And the way a board refreshes is it has a skills matrix. It looks at the skills that are in the board, and it looks at what skills it needs to govern forward. So it looks at the gap, and then typically as you come to board refreshment, you'll start to look at seriously at how you fill some of those gaps. That's typically a rolling process of maybe 3 to 4 years, maybe even 5 in some cases. So it doesn't happen quickly. I have no doubt that it will happen in time, because of the ESG pressure is intense and intensifying. In the meantime, though, what I'm seeing happening is that boards are asking for ESG advice, so that they're bringing people on as board advisory roles and asking those questions. They're also asking the CEO more structured questions around ESG than before. So previously the questions were a little bit vague. The intent wasn't really clear. Now I'm seeing more and more of intentional questions. So tell me about the supply chain. How many links down can we see down the supply chain around modern slavery? So the questions are becoming a little bit more pointed. And that's enticing the CEOs to ask those questions of the executive leadership team. So I think it's getting there in several ways. I think ultimately I'm hopeful that boards will have a strength of ESG knowledge within the board structure itself. But like I said, I expect that to be a slow evolution rather than a fast transition.
Mm-hmm. And so CEOs obviously playing a critical role there in these large listed companies with these evolving demands. How are they coping, with this pace of change?
Yeah, that's a good question. I think they're having to cope, and there's no choice. You're pinned. You're asked questions by your board members. You're asked questions by external stakeholders, and there's no dodging that particular issue. In a similar way to the board position, but slightly differently. With a board, you've got a diversity of skills that you can bring on, and you've got a mix that you can use. The CEO, unfortunately, tends to be the meat in the sandwich, and so has to ask questions. What I'm seeing more and more is that the executive leadership team is being encouraged, shall I say, to think about these ESG factors. The chief risk officer, or the risk component of an organization, is being asked to find those non-financial risks and bring them into the fore. I'm finding a lot more discussion around reputation, and interestingly, reputation as a consequence of a consequence. So something happens, and as a result of that, stakeholders respond, and so reputation is a consequence of a consequence. And so I'm seeing a lot more structured evaluation of what these, previously soft ESG factors used to be in a CEO's remit.
Interesting. And you talked about the growing investor and consumer focus on ESG issues. Which amongst those or other stakeholders do you think are having the most influence? And are there any particular trends that you're seeing?
Yeah, I think the investors, probably institutional investors, had a head start on this. I think that, since the principles of responsible investment came into play, the conversation has been live. So I think that has been rolling along, so that they've had a head start. I think, the insistence on the TCFD, the sharper focus in the investor roadshows on those questions has meant that the investors, in my experience, still have the dominant role in this narrative. However, what I am also seeing is from the top end of the market, so from the retail segment of the market, particularly around emerging technology, EVs, and as I mentioned before, technology, there's more of an awareness of these. So the if you like, the newer industries, or the industries that are future facing, are beginning to ask these questions as well, and then pushing those expectations down into the difference between long-term relationships or long-term buying agreements and short-term or spot buying agreements. So I'm seeing that shift as well. I think the investors still wield a lot of influence and will continue to do so for a long while yet. I think an untapped area is our own people in organizations. I think they tend to be the silent participants, and a lot more could be unleashed there. But for now, for me, it's the investors still.
Great. Well, good note. We've got a couple of great questions from within our team. What are some of the common issues that boards are asking their board advisors, board advisory people about ESG?
That's a good question. Look, climate is 4 out of 5 times the number one issue that's asked about. And the question isn't so much how do we do this, but how much is enough? What should we do? What's our risk? What's our exposure? Why is it that exposure? How do we think about this? So climate is typically number one. Number two tends to be, I didn't realize. Well, it's not that I didn't realize, but ESG is such a wide ambit. So what sort of governance have you seen in other companies to manage all these different things, from human rights all the way to climate change? Very, very different things, bribery and corruption. How is that being done? And so the bigger question tends to be about how do we get our arms around what seems like a very, very large list of very varied topics of conversation with our investors. And the answer to that often is, well, what are your most material? What are the things that are causing you risk? Don't try and eat the elephant at whole. Do it a bite at a time.
Great. Another question around supply chains. As they start to become more strategic and delivering critical services, you mentioned EVs, sort of energy, materials generally, and potentially become renationalized, what are the challenges in ensuring that the ESG focus is kind of equal between boardrooms, investors, and also governments, recognizing the interplay between all of those?
Yeah, it's a good question. I mentioned before that, the law is typically a lag indicator of what society wants. And so, again, in my experience, governments are slower coming to the table. There has to be kind of a business case, if you like, in the socioeconomic structure before governments get engaged in earnest. Otherwise, it remains a policy discussion for votes. So I think the equalization really, I believe that industry and leaders of industry can be more vocal about these ESG issues, about the ESG focuses. I mean, if they're reliant on investors in the market to meet these ESG requirements, then really it's in their best interest to have that conversation. I think the more that narrative occurs, the more likely it is that governments will be folded into that. So whether or not that becomes an equalization, but it may become more of a collaborative interface than we're seeing at the moment.
Great. A question around institutional investors. Often they take a medium-term view, 3 to 5 years, in the companies that they might be investing in before they sell again. And every time those sales processes can disrupt the normal leadership focus. How does that affect the ability of leadership teams to really focus on and implement long-term sustainability plans and strategies?
Yeah, actually, that's an excellent question, because it is an issue, that the institutional investor churn. But if you take a step back and you think about portfolios that institutional investors manage, asset managers might manage, you'll see that it's sector based. So it's a sector mix, and within that sector, we look to certain companies that have a competitive advantage over another company within a sector. So let's say if we're looking at the energy sector, we'll say, here are the 3 companies for these good reasons. Some of them ESG, many of them balance sheet related, of course, that we would invest in for that 3 to 5 years. Now, those reasons don't change. So when the institutional investors jump from, for example, when they go from a Rio Tinto to a BHP, the focus that they apply to the ESG factors hasn't really changed. So I think there's a sectoral based approach. Now, if I was a sectoral CEO and I know that my tenure is somewhere between sort of 5 and 7 years, I'd want to make sure I'm on top of that. So I think there's a natural tendency for us to converge, even though there's a slightly disruptive, as you say, medium-term chopping and changing. So a company might say, oh, we were trying to do our human rights in our supply chain really well. Now we've lost the investor, we might as well do less of it. I think that might be a knee-jerk reaction, but if you're in the sector as a whole, the sector as a whole will move forward.
That's great. Who do you think is defining ESG priorities globally, and how diverse is that actual space of stakeholders and pressures, around that?
I actually asked this question once, because the priorities were, I was feeling the priorities were leveled at me in my role from institutional investors. So I asked that very same question. So Who's deciding this? Is it your CEO? Like, why? And it is the retail investors that are part of the ecosystem, and it's a very rapid increase. If you ever get a chance to look at an investor analysis of age and geographical demographics of investment, definitely have a look at it. You'll be quite surprised at where the money's coming from, what's changing. And the old paradigms, which sat with the baby boomers and the Gen X for a very long time, are kind of phasing out. So the priorities are being reshaped by a new class of actor, and they're investors, they're also consumers, they're buyers, they're also people that work for you, and it's really just a new generation coming through, and that new generation has command of many of the investment dollars that are particularly going to large superannuation funds and getting put into the money markets. So that it's sort of a societal drift that is then captured by smart heads of investment firms, and so they crystallize that and they say, this is what we want. If they didn't do that, they'd be out of business. So I think it's a wholesale drift. It's not a step change. It's a wholesale drift, but it is by a large number of semi-invisible people that gets collected into the large organizations.
Interesting, thanks. So you mentioned that companies are moving from the Global Reporting Initiative, GRI, to SASB reporting, and also later that ESG is moving from an investor focus to a wider stakeholder focus. So Dave has thought it might be useful for you to note the difference in objectives between the two. For example, that SASB is focused on investor relevant information, whereas GRI is sort of that broader stakeholder audience. Can you expand on this and perhaps other moves that are underway to provide more relevant information for markets and other stakeholders?
Yeah, and I was around when the GRI. I was starting my career when the GRI was formulated. So, and I remember it went through quite a significant stakeholder engagement phase, and it really tried to capture everything that would be worth thinking about in the ESG space, right? And that's a good thing, because it's given us a long list of all of the things that might become an issue. I think what SASB has tried to do is to focus it more on the, as you say, the investment community. So distill the GRI list from a longer list to a slightly shorter list. I think at the end of the day, that speaks directly to risk, and the risk it speaks to, I think, is what is the risk to your organization if you were to not manage these smaller set of issues well? And also, what would be the risk in terms of your stakeholder sentiments if you were not to manage those well? And I think that's what sort of helped narrow it down. I think one of the things that is not done very well in industry, we speak to institutional investors because that's where the money is coming from. We don't speak a lot to, we speak to our customer groups, of course, but we don't speak to other areas of civil society. We don't try and understand what else is material, what are the other bits of the GRI we ought to be including in our conversation, and what for. So I feel that at the moment we're in this the space of the habit of the last 20 years, where we have our punch list of things that we want to talk about, but the risk lens is not always there. And that sort of brings me back to my point about the Audit and Risk Committee and the Sustainability Committee. Once those two start working at a board level, then what's important to the company and its stakeholders becomes more focal in that list.
Excellent. So that what you were mentioning there about kind of reaching out to sort of and understanding those civil society perspectives flows into this next question, which is around risks around security of supply related to ESG. For example, litigation against new proposals for resource extraction could stall a project for years, which could be maybe avoided if stakeholder management was done well, particularly perhaps at a local community level. Are you seeing those types of links being explored and discussed in the extractive sector at that kind of board and executive level? And how, so that's in the company side, and perhaps also how investors are taking community concerns into account?
Most definitely. And it is because in accessing capital, your return on capital, your time frame for your return on capital becomes quite a fundamental decision-making point. And so if you're looking at, 4 years or 7 years for beginning to see a return on investment, then a 2-year hiatus with stakeholders, communities, landholders is quite a large dent in that profile. Right? So the providers of capital have been asking that for quite a few years. It hasn't been an unknown proposition for them. But what we're now seeing is that the risk weighting on the capital is starting to take effect. So if there's a perceived risk, then the capital offered to you is at a couple of percentage points higher than if the risks weren't there. And that conversation is starting to become more prominent at the board level, because when you start talking, $1 to $10 billion, those percentage points add up significantly towards shareholder value. So that's how I'm seeing it progress. It's still very much a show me the money type conversation, but it's got more teeth and claws than it did even 5 years ago, I think.
Excellent. Well, we got through some really great questions, so I want to thank everybody for sharing those. I think we got through everybody at least once. There's a couple we didn't get to, but thank you for those, and apologies about that. Raj, that's been a really terrific both presentation and discussion after, very insightful, wonderful to have the reflections on that kind of pace of change and the nature of it as well. So I want to, thank you on behalf of all of us here at ASI for sharing that and for spending some time with us today. Thanks everyone in the audience. Thanks, Raj. Thanks everyone in the audience as well, and keep an eye out for upcoming sessions. Have a great rest of the day. Thanks again, Raj.